Well, welcome back to Finance Uncut. On today's episode, the real silver squeeze. So, what is the real silver squeeze? Well, to get the first part of that answer, let's cut to a clip with Rick Rule.
But the most pernicious, of course, is negative real interest rates. Described by Franz Pick as certificates of guaranteed confiscation, or by Jim Grant as return-free risk. Think about this. The U.S. 10-year Treasury, they pay you 1.5% in a currency that they acknowledge is depreciating at 5.5%. In other words, the U.S. government absolutely promises to diminish your wealth by 4% a year compounded over 10 years. Not very attractive. So for those reasons, I believe that precious metals prices will trade higher. How much higher? I don't know. What I can tell you is this. Over the course of my professional career, precious metals and precious metal securities have had about a 1.5% to 2% market share among total savings and investment assets in the United States. Right now, the same number is less than 0.5%. If demand for precious metals and precious metals equities merely returned to mean, if they ignored quantitative easing, debt and deficits, and negative real interest rates, demand for them would triple. And that's precisely what I think is going to happen. On top of that, Jake, the precious metals equities, relative to the free cash flow they're making at today's commodity prices, not the prices that I think the commodities are going to go to, at today's commodity prices, are cheap. And as you've come to know from these interviews, Jake, I love cheap. So I'm attracted to the precious metals equities. I'm attracted to the great big ones generating free cash flow. I'm attracted to the somewhat smaller ones that are generating even more free cash flow relative to their market cap, because I think the big ones will take them over. And I love to participate in takeovers. I'm interested in the development stage assets because the industry doesn't have very many good development stage assets in the pipeline, and they'll be taken over too. I'm interested in discoveries. It seems that there's things of interest throughout the precious metals equities landscape. I'm particularly interested because of the poor price performance in silver and silver equities. You'll recall earlier this year, they had the silver squeeze, which people suggest now has failed. It hasn't failed. It hasn't gotten started. The real silver squeeze is not about a whole bunch of new young people being attracted to the physical silver market so that they can break the banks. The real silver squeeze is when demand for silver and demand for gold return to their 4-decade median or mean, when current demand grows by 3-fold or 4-fold in a market where silver supply can't increase that much. And the most leveraged asset of all, Jake, are the little silver stocks, even the big silver stocks. Our mutual friend, Doug Casey, told me 20 years ago, and it's true today, that the combined market capitalization of the legitimate silver sector is so small that when the generalist money tries to crowd its way into it, it's like, quote, siphoning Hoover Dam through a garden hose. It just doesn't work. That's happened to me twice before in my career, Jake. And while the returns that I enjoyed weren't quite as glamorous as the returns that I enjoyed in the uranium sector, the truth is that the silver sector is one where nobody has any expectation for success, when success is, in my point of view, almost inevitable.
All right, so let's go back a little bit to earlier this year when the LBMA published their report, the Silver Investment 2021 report, and I'll put a link in the description below. You can download it and read it in your own time, which looked at the recent developments in the investment silver sector. In particular, they looked at the silver squeeze that happened in February. And so we just need to have a look at this first. So some key things out of that report were regarding the 20% increase in investment demand for silver in 2020. They noted the past 12 to 18 months have witnessed some incredible developments in the silver investment market, including a dramatic improvement in investor activity. The next point, of course, much of the focus of that Silver Squeeze social campaign was on the ETFs, more broadly described as ETPs in the report. So exchange traded funds, or in the report they called it exchange traded products. Early 2021 saw an unprecedented 110 million ounces added in just 3 days. Although some liquidations emerged, there were concerns that London would run out of silver if ETP demand remained at a high level. Commenting on the logistics constraints of London-based custodians, this year the location of the custodial vaults has come into sharper focus as ETP demand has jumped, leading to concerns about the potential availability of metal. As the social media frenzy gathered pace in late January, demand for coins, bars and ETPs all jumped. For the latter, global holdings surged by 119 million ounces in just 3 days. This was concentrated in the iShares fund SLV, which I just don't recommend, where holdings rose by 110 million ounces. Given that most of this metal was allocated in London, fears emerged as to whether there was enough silver should demand continue at this pace. And had demand in iShares continued at the frantic rate of late January, early February, it would only have been a matter of weeks before London's existing stock was used up. And that's the thing. So they admitted that the silver squeeze was working and that they were concerned and worried and thought that it would only be a matter of weeks until delivery couldn't be met. While it would have been surprising to see ETP demand maintain this pace of buying, the concerns were still very real. This reflects both the time required for a refinery to convert non-good delivery material into 1,000-ounce bars approved by LBMA as good delivery, and then delivery of this by sea freight into London. That is a remarkable admission for someone like the LBMA and highlights just how close the campaign came to breaking the system. They then looked more broadly at available stock, asking the question, the recent jump in ETP demand has led to fears as to whether there are sufficient above-ground bullion stocks. Should ETP holdings see a further sharp increase? So remember the campaign, the Silver Squeeze campaign, back in February, back at the start of the year, the LBMA all but admitted that they were concerned, they were worried. We had SLV change their prospectus. Now, I don't tell people how to invest or what to invest in, but for those that were just simply wanting to trade the price of silver, you would have been doing a much better benefit or gain had you gone into the PSLV, because buying the PSLV, the Sprott Physical Silver Trust, they then go and buy the underlying metal, silver. They are a physical trust, and it's very liquid, so you can get in and out. And there is a minimum amount of silver you do have to buy, but you can actually get delivery from the PSLV, where the SLV you can't. And the SLV, to in my mind, is all a heap of BS. I don't trust it from a bar or so. And so people that just they didn't want to hold the physical, should have gone into PSLV, because you could have traded the silver on the silver price, but you would have been doing the whole physical thing. A lot of help there. So a couple of other interesting points is when you look at the World Silver Survey for 2021, institutional investors were non-existent. They weren't there. So this was retail driven. This was retail driven. So the price of silver. What's interesting, talking to some of my institutional investor colleagues or friends, and that they've said one of the things they wanted to see was they just thought this was a frenzy with retailers, and they thought it would drop back to $15, $17 an ounce. Now it hasn't. It's traded between $22 and about $25 an ounce throughout the year, after the big run up earlier in the year. And that's actually given institutional investors some confidence that that there is a floor, that there is an investor demand there, and it's certainly, the whole campaign has certainly woken a lot of people up and taught a lot of people and around, our monetary system, fiat currency, real money, sound money, and gold and silver. And so that's been a positive thing. So as Rick said there, the real silver squeeze is when the investors, just normal investors, go back to investing in this back to their mean, which is about 300% higher than where it currently is. And when the institutional investors start jumping in, that's going to make a big move. So this is the 2020 edition. I couldn't find a more updated one, but this is on Visual Capitalist. So when you have a look at the size of silver as a market, versus everything else, military, all this sort of stuff, coins, Fed balance sheet, well, we know that's grown a lot since then. The gold market, Fortune 500, the stock market. So here's my argument. So when we start to see, risk off, investors pulling money out of, these trades with, risk on and moving into risk off, such as gold and silver. So you're going to take some of this out of here and the currency supply. Okay, so you take some of this and maybe even real estate and some other things. All right, so we can scroll down. You can have a look at the derivatives. And remember, this is 2020, so this has only grown since then. All right, so when we get a bit of this institutional investor buying into the silver market, so we take some of this risk on off out of whether it's crypto, whether it's the bond market, whether it's and I do classify that as risk on, really. In an inflationary environment, it certainly is. The currency supply, people's got a lot of savings, stock market, and then they pour just a little bit of that into silver. You can see the size of the silver market. It's not going to take a lot to move this thing, and so that's another reason why I think it's, well, in my opinion, it's wise to have some silver as part of your portfolio. And in this report, also on Visual Capitalist, you can see that the fundamentals. So silver, we've got another dozen to 15 years tops worth of supply. So we're moving this green revolution, and there's quite a bit of silver, especially in solar panels. But funny enough, I actually also like zinc and copper as well for this play. So if we do have institutional investors pouring into silver, if we do have just investors in general going back to their mean, which is owning about 300% more than what they currently own in the precious metals market, then what's the best way to play? What's the best way to play it? What's the best way to invest in this sector? Well, let's cut back to a clip with Rick Rule.
That although I'm a very good investor, as a speculator, Eric's in a league all of his own. He really, truly is superb. I've known him for a very long time, and I'm in awe of his discipline, his tolerance for volatility, his tolerance for pain, frankly, and his timing. Understand that Eric is a legitimate billionaire. And what Eric is interested in is betting what would be, to most people, extraordinarily large amounts of money with a willingness to lose it all in hopes of getting a 20-to-1 gain or a 30-to-1 gain. I mean, Eric is a true punter. So the first thing I'm going to say to your audience is don't try this at home, folks. unless you have the fiscal and psychological stability to play the game. But what is useful to know about Eric, and the part of Eric that I try in my own small way to emulate, is two things. He is a chartered accountant, which means that he understands economics and money from a practical viewpoint. He's not like a guy at the Fed who, gets to counterfeit and tell you what to do. Rather, he is a guy who studies the real economy and speculates based on his understanding of the real economy. And he understands as a chartered accountant that the current circumstance in its current form can't hold. That's useful. Eric is also a great historian. And Eric knows from his life's experience that precious metals bull markets are much greater in terms of duration and dimension than other people know. Most people, I shouldn't say most people, but many people have said to me, Rick, this bull market is by your reckoning already long of tooth. It's already 4 years old. They say the same thing to Eric. Both of us point out that the two prior bull markets in our career were 10 or 11-year bull markets, which is to say, we aren't halfway through. And in terms of dimension, people say, well, the silver price has already gone from, $14 to $22 or $23, well, 30 on its way, and then on its way back down. Hasn't the easy money been made? Well, in the first bull market of my life, the silver price went from $1.50 to $50. In the second bull market of my life, silver went from a more advanced $5 to $50, which is to say a 10-bagger. So when people say to me that the bull market has run its course, either by way of duration or dimension, I say to them, perhaps you're not as old as me. Perhaps you haven't studied history, or perhaps you were just a lousy student. But the truth is that I think that the precious metals bull market is not at its midway point, that wind is in the sails of precious metals. And I have noticed in prior precious metals bull markets that the first half of the bull market was gold-centric, and the second half of the bull market was silver-centric. And when the momentum was established by gold, then silver picked up. And when the silver was established by the momentum occurred in physical silver, then the silver stocks, at least the high-quality ones, not the junkers, but the high-quality ones, really surprised people with the extent and the rapidity of the rise. Again, for an illustration, what I would point your younger listeners in particular to was what they saw happen in the uranium stocks over the last 18 months. Uranium did nothing for 3 years while the arithmetic was evident. It did nothing, even though the writing was on the wall that uranium had to go up and uranium stocks, pardon the pun, had to explode. We have the same circumstance in front of us now. The writing is absolutely on the wall with precious metals. History teaches us that when momentum is in precious metals, the market becomes silver dominant. And history teaches us too that the most explosive asset class in precious metals is silver equities. It's right in front of you. The lesson with regards to the uranium equities is right in front of you. But for most of your listeners, until the thesis has run its course, which is to say, until the opportunity is less attractive because of price, people won't care. The game is to care when Eric Sprott cares, when the arithmetic is right and nobody else gives a damn.
Yeah, so absolutely, I believe in buying physical, having physical, but for numerous reasons. Having it both nearby, but also in storage. And then, to be honest, personally, I like to trade the silver price as well. I've done a video on wealth cycles, so there's certain gold and silver that I own that I'll probably never sell, especially gold I'll probably never sell. But I do like to trade the silver price, and I use the PSLV to do that, okay? Because I'm also helping the whole demand side of thing. I'm not just, playing in the paper market, which does nothing to help the real value of silver. So I do that. But the other way is I leverage into the mining space and the exploration space. And you can just go back and have a look at last year when there was movement in the gold and silver market, both the underlying the metal market. But then you have a look at the flows into the miners. Most of the major miners doubled in price from their March low through to August, September last year. Your smaller miners, some of them tripled. And your explorers, well, I've shared in other videos my Explorer Chalice. That was a 25 bagger, 2,500%. Some of my other stocks were up 300-400%, those Explorers. So there is huge gains. And if we just go back to, and I've shared this chart before, if we go back to March 03 to March 08, and you can see the black line there, the dark black line, or the thick black line there, you can see that silver went up 330 odd %, yet the miners did much better. And then in the second part of the bull market there, between November 08 and April 11, silver went up 398%. And once again, the miners, predominantly, if you bought the right miners, the good miners, they made even more gains. And so for me, this is speculation. And I've shared, Doug Casey's book, Crisis Investing, and some of the tips that I learnt from Doug. And I'll put a link in the description below to that video. If you haven't watched it, do so. Because a lot of what I do and what I've learned is from that book, from Doug Casey. And so, this is what I'm after. I'm after the 10, 20, 30 baggers. I'd love to get a 100 bagger. I haven't got one before. I've had 10 and 20 baggers before. A 25 bagger, obviously, with Chalice. But I haven't had a 100 bagger, but I'm after those. And so I've got a lot of positions in a lot of the exploration and miners, and the small miners. That's because I'm bullish the underlying metal, both gold and silver. But and the fundamentals are there. We're going to need more silver. We're in an inflationary decade, so both silver and gold the demand for that is only going to increase, in my opinion, as the decade goes on. And yet we're going to get lower supply. So the fundamentals add up for me for higher gold and silver prices. And once again, if the just normal investors come back into this market, we're going to see a very, very nice rally up. If the institutional investors start pouring into this, then we're really going to see some tremendous wealth gained in this market. But anyway, that's my opinion. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you again on another episode of Finance Uncut.